Hello friends, I'm Elijah Lim and welcome to this ACE review video. And as you might have guessed from the title card, we'll be talking about financial accounting, or as you may know it, ACCOB2. Specifically, its lesson on plant assets and natural resources. How fun. Now, obviously, in this review, we'll be talking about property, plant, equipment, under it, its cost, its various modes of acquisition, its depreciation. And as you might have guessed as well from the chapter's name, we'll be also talking about natural resources, its cost, and its depletion. Now, moving straight on from property, plant, equipment, or PPE, in order to understand this specific account title, you have to understand as well one of its key characteristics, and that its cost should be measured reliably. So much so that there are guidelines and procedures in place on how to attribute costs properly, like with the components of cost, subsequent costs, and so on. Now, here's the funny thing. Even with those guidelines in place, the topic introduces us still with specific cost titles for specific account titles. Let me show you. Like, for example, with the specific account title land, it has its own specific cost title in that it's purchase price, legal fees, and broker's commission. And the account title, both buildings purchased and buildings constructed, have their own both distinct cost titles that we should be aware of. And specific and similar PPE follow the same pattern of their own separate cost titles. Now, unless I'm blind to a bigger picture, unfortunately, there's really no pattern or easy solution we have to easily differentiate and distinguish the proper cost, the proper account. And as if we're not masochists enough for ACCOB2, it's usually encouraged that we just memorize these terminologies right off the bat or right off the screen or book you have. So that might be the case. I can still offer you some advice that, let's say, more or less would help you differentiate or allocate the specific cost in the right account title. First advice is know the terms. Second advice is know the purpose. I know they sound obvious, but hear me out. Know the terms because it would actually help you to differentiate the terms away from an accounting perspective. Like, say, with broker's commission, you don't regard this term as a term under land, or realtor commission, a term under buildings. You try to find their own definition away from accounting. Like with brokers, you try to look for the definition is, what is a broker? What do they do? Or with realtor, what does a realtor do? What does the word mean? Now, by knowing their separate definition away from accounting would actually help you know what account title should they be allocated on. Now, with the second advice, with know the purpose, by knowing the purpose or by knowing the reason why the cost was incurred, it would actually help you trace back to the subject or the account title it was incurred for. Like, for example, payment to tenants. That specific cost title is both under land or building, but only under specific context or purpose would you be able to know if that specific cost title is for land or for building. Now, same with other terms, such as with temporary safety fences and fence. Only through their purposes, their distinct purposes, would you be able to know if it's for buildings or land improvements. Now, moving on to the next segment, which is the modes of acquisition. Now, modes of acquisition, it will help you if you would still think about it as measuring costs still. But instead of the usual 1v1 or straightforward purchase interaction, modes of acquisition, hence the name, considers various types of transaction an entity might pull to acquire a plant asset. For example, with lump sum or basket purchase. This type of mode of acquisition is that when an entity purchases multiple of plant assets for one purchase price, and there's a problem there, and you would encounter a problem if you try to measure its cost simply or in a straightforward manner. Let me show you with an example. Say with 750,000 pesos, an entity managed to acquire land, building, equipment. As you can see that it's kind of difficult to find land or the specific cost of land with the lump price of 750,000 because it shares that purchase price with two different other plant assets. Now, how do you get their cost? Now, by using lump sum method is that you first turn to their fair values. And through the accumulated sum of their fair values, you try to get their percentages or their proportion of that accumulated sum. And through their proportions, you try to match them with the purchase price. And with that, you would acquire the right proportion that they have to their cost in relation to the purchase price. In that, like with building, it's 40% because its fair value of 400,000 is the 40% of 1 million. And you match that with 750,000, you get the right cost of 300,000. So on with other account titles, such as with equipment, 20,000, with the correct cost account or amount of 150,000. Now with the next mode, which is deferred payment, it is when an entity delves into a contract payment and pays a plant asset in installments, and it usually uses notes receivable. Now, cost is measured in two ways, which is the easy way, cash price equivalent. I say it's easy because if cash price equivalent is mentioned anywhere in the problem, that's it. That's the cost. You just copy it right off the bat. However, if it's not mentioned or it's indeterminable, you try to look for its present value or the present value of the notes used. And when I say present value, it's the same concept of a previous lesson. Now, if I still know how to count right, I'm guessing it's chapter 3 labeled receivable. It shares the same concept. Now, going to an example with this deconstructed illustration, as you can see, cash price equivalent is not mentioned. So obviously we'll go to present value. Now, first is that you first try to find, if any, a down payment because it's the cost already incurred for a asset, which is in this case 100,000. And after that, you try to get the present value of the notes by the semi-annual payment and the interest rates given. And with those two, down payment and present value, you add them up. That's the cost of equipment. You might ask, what's the present value, or how would you derive it? Well, because like I said, it's touched in a former chapter. You could just refer to those other videos we have for present value. However, in these types of problems, because it's a different chapter, usually they already give a present value table in that they already give you a variable to just multiply on to get the present value. And just to backtrack, say a purchase price or cash equivalent is mentioned anywhere in the problem. Like say the purchase price of the equipment is, the cash price equivalent is, that's the cost. In this case, 450,000. You don't have to calculate the present value anymore. Now, for the next mode of acquisition is the issuance of shares. It is a lot easier relatively to the two former modes. In issuance of shares, as the name implies, it is when an entity issues the shares of a company to acquire a specific plant asset. Now, issuance of shares works like a priority list. It has like a priority on how to measure cost. If it's not mentioned, you move down to the priority list. Like for this example, you first have to find the fair value of the asset received. If it's not given, you move down to fair value of the shares issued. If it's not given, you move on and on and on. However, there's an exception to this rule, in that if it's traded in an active market or a market with a high trading volume, you use immediately the fair value of the shares issued. Now, for the next mode of acquisition is donation, another straightforward, easy method, in that you only have to measure the fair value of the asset. And sometimes there's incidental cost. Since donation doesn't really have a purchase price because it's a donation, there's sometimes incidental cost, which sometimes comes in the form of transit cost, testing cost. If any of those costs is incurred, you just add them to the fair value. So basically it's just addition. And for the last mode of acquisition is the exchange. Exchange is when an entity exchanges with another entity another plant asset, usually with a purchase price. Now, exchanges can measure cost in two ways, which is first, the carrying value and the cash paid, or the fair value and the cash paid. Now, you might ask, how would you know to use which, carrying value or fair value? It is usually indicated with a commercial substance, in that if there's commercial substance, you use fair value, and naturally, if there's no commercial substance, you use the carrying value. Now, how would you know if there's commercial substance? Commercial substance is present, usually it's already mentioned in the problem, so yeah. But if in the sad case it's not mentioned, commercial substance is indicated when there's a change in the economic cash flow of an entity. Now, to conceptualize in an example, an exchange with commercial substance, you use fair value with cash paid, you get the cost. an exchange with no commercial substance, you get the carrying value this time, cash paid still, cost of equipment. Another thing with exchange is that you can calculate or find out the gain or loss in exchange. By doing so, you have to find the difference between the fair value of the equipment and the carrying value of the equipment. Now, gain or loss can only happen or can only be measured if there is commercial substance. But if there's no commercial substance, you don't really have to calculate, or there's no way to measure gain or loss in exchange. Now, for the next segment, which is depreciation, it's a fairly familiar term for past account takers, be it for fundamentals or ACCOB2. It's in that it's the wear and tear of plant assets. Now, with depreciation, in order to derive it, you only have to watch out for three factors, which is depreciable base. It's either the cost or the carrying value, the scrap value, and the estimated useful life. Estimated useful life is usually translated or expressed by time, usually years, outputs made, or hours used. Now, depreciation have several methods, some straightforward, some I wouldn't say difficult, but let's say it requires more calculation. For the first method is the straight line method. It's quite straightforward, as the name implies. Depreciation is derived by subtracting cost with the scrap value divided in the life in years. Now, straight line method measures depreciation as a matter of passage of time. Now, for the next two method, which is under activity method, by the way, as the name implies, measures depreciation by its activity or the economic use of a given plant asset. Now, the first method is the work hours method, which is derived by depreciable cost, which is, by the way, a shortcut way of saying of cost already deducted by the scrap value, divided by life in hours, multiplied by the actual hours. Now, with the other method, which is production method, it is pretty much the same. You just have to switch out the estimated life in hours and actual hours with the estimated life in units with the actual outputs or units made, hence the name production method. Now, for the next method is the sum of the years method. It measures depreciation like straight line method in that it measures it through a passage of time. But sum of the years method rides on an assumption that economic use and depreciation is at its highest in its initial years, and it dwindles down as the years go by, meaning depreciation is higher in its first years than the later years. Sum of the years method is derived with the depreciable cost multiply remaining life divided by S. How do you get remaining life? Remaining life is usually the estimated, it's not usually, it's the estimated life. However, it's in a backwards count. Say you're looking for the sum of the years or the remaining life of the sum of the remaining life of a 5-year life asset. So in its first year, the remaining life is the full 5. In its second year, it's 4, 3, and 2. It's like a backwards count. And then the S stands for the sum of the years. And sum of the years, it's literally the manual sum or the adding sum of the years or the estimated years. Counting manually the sum of the years is usually tedious, so there's a given formula in that S is derived by n plus 1 multiplied by n divided by 2. And n is represented by the estimated life. To use the previous example, if it's 5, it's n plus 5 multiplied by 5 divided by 2. Now, for the last method, finally, is the double declining balance method, which by the way rides on the same assumption of sum of the years method in that depreciation is at its highest on its first years and goes down. Double declining method is derived by double declining balance multiplied by carrying values. 2 notes. First note, it's the only method to use carrying value, meaning you don't subtract it with the scrap value. Second, double declining balance is derived by first initial year. What do I mean with initial year? It's literally 1. It's literally the number 1. It's almost a constant variable. You always use the number 1. Divided by the estimated life in years. So using the previous example of 5 years, it's 1 divided by 5. If it's 10 years, it's 1 divided by 10, and you get the idea. And after that, you multiply it by 2, hence the name double declining. Now, for the next slide is the illustration or an example of solving it. Now, we will be breezing right through the first 3, and we'll only be focusing on the latter 2 because the first 3 are much straightforward, and you can always pause this video to see, or if you want to see my wonderful calculation, Anyway, you get diminishing balance by, like I said, with the carrying value. You don't deduct it with the scrap value, hence the 500,000 is still intact, and multiply it by the 20%. How did you get the 20% of the wall declining? Like I said, you first used 1, it's like a constant variable 1, and divided by the estimated useful years, which is 10 in this case. So 1 divided by 10, and again multiplied by 2, you get 20%. And for the sum of the years digit, first 450,000, the depreciable cost 500,000 minus 50, like all of the different methods preceding it, multiply by the 10 divided by 55. First, how did I get 10? 10, like I said, is a backwards count of the estimated years. Because it's the first year, we use the first or the full 10 years of the estimated life. If it goes on, you just, count it down, 10, 9, 8, and so on. As for the 55, how did we get 55? It's the sum of the years. It's still used to compute it manually, so we use the formula, which is 10 plus 1 multiplied by 10 divided by 2. And that's the sum of the years. Now, for the next segment, it's not really part of depreciation, but it's part of the life cycle of a plant asset, so nonetheless, pretty significant. Now, retirement and disposal happens when an entity retires its asset and sells it, usually because it has fully depreciated over, or it just wants to sell its asset for any number of reasons. Now, retirement and disposal is only concerned in one thing, and two things. It's either a loss or a gain on sale. Now, there's really no formula, just a logical pattern. A loss on sale will always incur with if the carrying value is greater than the cash received. And the gain on sale will always happen if the carrying value is less than the cash received. Now, side note, carrying value is derived by deducting the initial cost of the PPE by the accumulated depreciation it has acquired throughout the years of its use. Now, for the next, I would say, sister topic, it's the natural resources. Natural resources, though it's a different account title, it similarly works like PPE. Because first, you measure its cost. So thankfully, it's a lot straightforward in that it only comprises of the acquisition cost, exploration cost, development cost, and restoration cost. Now, what is the difference between the four? Because natural resources isn't simple in a way that you can't just, get it off. There's like a process on how you acquire natural resources. It's better explained in an example. Say like you're finding the natural resources of mineral ore. In order to get the mineral ore, first you try to buy a land that has that mineral, that's the acquisition cost. You bought that land. Now the exploration cost is that after you bought that land, you try to find the mineral ore in that land. So that's the exploration cost. You have to find that natural resource. And for development cost, it is when you finally found that natural resource or mineral ore, and you try to dig it out, like say either from human labor or through machine, and that's development cost. And restoration cost is simply because we're sustainable, and it's usually legally required for us to restore a site use. Now, with PPE, natural resource has its own depreciation in a form of depletion. Like depreciation, you only have to look out for 3 factors, which is the depletion base, salvage value, and the estimated useful life. Usually, estimated useful life is expressed in outputs. Unlike depreciation, it's expressed in outputs, hours, and years. Now, depletion has 2 formula, which is to derive depletion cost per unit, which is derived by total cost minus salvage value divided by total estimated units, and the depletion expense, which is the depletion cost per unit derived multiply the actual units extracted. Now, to give it more thought on a deconstructed illustration, first you get the depletion cost per unit, total cost, which is the 4 costs minus the salvage value divided by the estimated useful life, and you get the depletion rate per unit. And after that, in order to get a depletion expense, you multiply the depletion rate per unit to the actual resources extracted, and you get the depletion expense. Now, before we move on, you might be wondering why did I kind of made it more complicated by separating the 2 formulas that are already somewhat connected? Because this kind of problem or this kind of lesson usually asks for the COGS2 other than the expenses. COGS, which I mean cost of goods sold. And it is helpful if you already have the depletion rate per unit ready at hand instead of, solving it over and over again as they ask for it. Cost of goods sold is derived from, or it can be derived in depletion, is when you multiply the depletion rate per unit with the units sold. To elaborate more further, though it's not written, say the resource extracted, which is 30,000, 20,000 of those extracted units were sold. So to get the cost of goods sold, you multiply the depletion rate with the units sold, and that's the cost of goods sold. And with the ending balance, you just multiply what's left, and you just follow that logic. And if I'm not mistaken, that's the last bit. So thank you, everyone. I know this video is quite longer than the rest because, well, ACCOB2 in general is a lot thick, for the lack of better term, unhealthy thick, and this specific lesson more so. If you're still confused even after this video, well, that's the Eli difference. Well, aside from joking aside, I mean, if you learn something of value, then great. If you're still confused, well, I'm open in answering questions, whether in the comments down below, or you can just PM me on Facebook. My name is Elijah Lim. No spam, please. Thank you.